Welcome everybody to our 2013 Annual Investment Strategy Conference. It's great to see everybody this morning, and we really appreciate your time, and we certainly enjoy your company. We do this every year, but every year something changes and some things stay the same. Before we begin, I also like to introduce you all to our team, our Haydel Biel and Associates team. These are people who help put this event together as well as support us each and every day to help service all of you. Our guest speaker today, as always, is our Chief Investment Officer and Portfolio Manager of Haydel Biel and Associates, my business partner, Chris Haydel. And I just wanted to share a little bit about Chris and I relationship and how I met Chris. You know, a lot of you don't know the story, but I thought I'd like to share a little bit about that to fill you in. Chris and I met around 2002. I was actually in another team practice with myself and 3 other financial advisors in West LA. And they brought Chris in as a guest speaker to talk to us about his investment strategy and investment philosophy. During his presentation, there was many things I understood, and there was probably more things I didn't understand. So if you have the same feeling today, don't worry, it's normal, okay? But along that, I knew that Chris knew exactly what he was talking about. He had been invested in gold. He had shared with us the story of him not buying into technology stocks in 2000. And I can assure you that 99.99% of the financial advisors I was working with were more along with the trend, investing in technology and just okay with putting their clients in these products. And Chris defied that. And after 2002, another loss in the markets, it was a challenging year, you know, to sit across clients and explain why their portfolios were down. And it's pretty difficult. But Chris didn't have to share that experience with his clients because his clients were positive. So I thought, well, you know, if it's something I'm not doing right, I have to change the way that I either do investment research, and I need to build my skills in terms of a portfolio manager and understanding what the markets are doing and how to invest clients' money so that we don't have this experience again. Because many of my clients at that point were asking me, wasn't there anything you could have done to prevent this? Or what could you have done differently than what we did? And so that made me think. And as a business owner, you know, I made a promise to myself that I wasn't going to allow myself to be in a business and to practice as a financial advisor unless I really believed and had the confidence in myself that I had the best investment strategy and best investment advice I could possibly give to my clients, which is the same advice that I would give to my family and friends. So many years ago, Chris shared with us that experience and his investment strategy and his investment philosophy, and I was inspired to know that there was something different that I needed to learn and something that I needed to grow from. And so I sought Chris as my mentor 10 years ago, and since then we've been working together. In 2004, we formed our partnership, and every year since then, aside from 2008, we've been very profitable in our investment strategies. So today, I want to welcome Chris, and he has some great research and thinking behind our philosophy and our current investment allocation that he's going to share with you. And I think all of you will be excited, hopefully leaving confident. And if you have any questions when this is all said and done, Chris and I are more than happy to meet with you in person. We know that this event is something that we do every year, but it doesn't take the place of one-on-one FaceTime. And so we're always open and available to meet with each and every one of you. So without further ado, please help me welcome Chris Haydel.
Thank you, Ricky, for that nice introduction. Ricky talked about profitable investment strategies, of course, leaving out what we all know has been a difficult period, probably the last 8 to 9 months especially. And I will address that and tell you about the changes that this has brought about in our practice and the changes in the way we are managing your investments. As we think about the adversity we've all been through recently, I'm reminded of the times when we've experienced this before, and Ricky alluded to some of them. Howard Marks of Oak Tree Capital has a quote that resonates with us very much. It's a quote geared toward those investors like us who are willing to take a contrarian investment strategy, who believe in their research and understand that fundamental economics will win out over short-term thinking every time. But as he notes, resisting and thereby achieving success as a contrarian is not easy. Things combine to make it difficult, including natural herd tendencies and the pain imposed by being out of step. Momentum invariably makes pro-cyclical actions look correct for a while, and that's why it's essential to remember that being too far ahead of your time is indistinguishable from being wrong. Given the uncertain nature of the future, and thus the difficulty of being confident in your position being the right one, especially as the prices move against you, it's challenging to be a lonely contrarian. And we felt lonely before. This time, of course, once again, it's new. The pain never recedes. We can take some solace in thinking about the previous times when we've been out of step and things have quickly turned around and corrected. That gives us confidence. But the old saying that past performance is no guarantee of future results also resonates with us. We have to ask ourselves, are we out of touch? Are we missing something? And this adversity is a great teacher. It first teaches us about ourselves. How do we handle it? For us, we absolutely turn off a lot of the financial commentary. Turning off the TV is probably a good idea. Taking long walks. Spending more time with family. Rearranging our priorities are some subtle changes we can make. For many of our clients, leaving those statements that come monthly unopened and stacking them away in the corner is one coping mechanism. But avoidance isn't always the best medicine. And we recognize, again, that this adversity has taught us something. First, one of our learnings is that, again, our past success is no guarantee of the future success we'll enjoy. And we have to think twice, revisit our assumptions, and understand where we are and where we've been. Every day we open our portfolios up and look at them. And if there are positions in that portfolio we would not buy today, we are under an obligation to sell those positions. After all, if you wouldn't buy it, why would you keep it? But we also know that our previous success has led to a concentration in a few ideas. These ideas are best expressions of what we expect or what we anticipate will happen with the economy. But we also know that there are other ideas out there which will complement what we're doing. We're naturally optimistic as human beings. This innate optimism is an expression of the first inalienable human right, which is self-preservation. Our lives are driven by goals and dreams, and those goals and dreams are an expression or derived from, a derivative of, that innate optimism. Daniel Kahneman, the father of behavioral psychology and often thought to be the father of behavioral economics and one of my intellectual heroes, has something he's called the availability heuristic. The availability heuristic simply means that we interpret events and our lives moving forward, because we can't know the future, based on the most recent data sets or recent experiences we've had. Sometimes you might hear that called a recency bias. So in that way, we think Saturday will look like Friday, which looked like Thursday, for the most part looked like Wednesday, and we go on. This is a potent combination. Our inherent optimism, this recency bias. It's also, as I jokingly sometimes think of it, a convenient form of amnesia. It helps us to live, to forget the pain of the past, and to focus on things which we believe will benefit us going forward. Well, at Haydel Biel and Associates, and as stewards of your capital, it doesn't help us to have amnesia. And we don't have amnesia. We're very clear that the period in which we live is unique in history. It's not that it's never happened before, but it visits us once every 60 to 80 years. this is the end of a very long debt and credit supercycle. And if you step back to see the forest, you'll recognize that this is the case. This chart shows the increase in gross domestic product, the growth in our economy for every additional dollar of debt that we've added. From 1947 to 1952, $1 of additional debt gave us $4.61 in GDP. So why not increase the debt? But like all medicine, like an antibiotic, this starts to lose its effectiveness and it wears off. And we need ever more debt to achieve the same result. Each additional dollar of debt generated 63 cents in GDP growth. From 1985 to 2000, that number dropped to 24 cents. Most recent numbers tell us up to 2012 that every dollar of additional debt is generating only 8 cents in additional GDP growth. And I would say we're probably at now the zero bound. The total assets of global central banks have exploded. 10 years ago, global central bank assets totaled $3 trillion. Today, that number's over 13 trillion. Now, how as investors should we think about this quadrupling of central bank balance sheets? It doesn't make me feel better to know that we've gone from $1 million to $1 billion to $1 trillion problems in the span of 10 years. And by the way, in a remarkable milestone of fiscal profligacy, the government of Japan last November crossed the threshold of debt totaling over 1 quadrillion yen. For those of you who are counting, that's a 1 with 15 zeros behind it. On the authority of legendary investor Kyle Bass, to count to 1 quadrillion, if it took you 1 second to count out each number, which itself is an optimistic estimate, it would take you 31,688,087 years, 297 days, 46 hours, 7 minutes. It's absolutely foolish for anyone to believe that this debt can ever be repaid. So in an environment where we know the policy response will be more money printing to every financial crisis, more financial and central bank easing, more papering over of deficits to finance profligate governments, how do we invest to protect your capital? Not in the span of 6 months or 4 months or even 8 months, but over the longer term. What's one of the most hated asset classes out there? If you're thinking gold, you're right. Well, at least by the financial establishment. But there's something funny going on. This chart shows the gold price over the last 13 years, from the year 2000 to the present. The gold price has rocketed ahead by 475%. Until its recent correction. The stock market, which garners all the headlines, has hit new nominal highs. The S&P is charted at the bottom for you. The S&P is up 1.7% over the same time frame. But you might as well pop the champagne cork because it's at a new high. In addition, if we were to adjust for inflation, the stock market is actually down by over 18% during that same time frame. Yet you'll never hear the mainstream press, you'll never hear the financial channels encouraging you to sell stocks because now is a bad time. And of course, they won't tell you to buy gold. But this chart's interesting because it highlights the difference between a correction and a collapse as well. If you've been invested with us and even in gold yourselves for most of this period, the recent 14% drop in the month of April is merely a correction. If you've been invested in the last year in gold, it's a collapse. The recency bias again, and our recent experience can't be denied. But what does this correction remind us of? The previous gold bull market, which happened during the 1970s, offers an interesting an answer to that question. During the 1970s, gold began a long ascent, starting in 1971. And beginning in 1974, it enjoyed a correction. The price had gone from about $25 an ounce officially up to $198 by December of 1974. And the price then corrected over the span of 18 months. About the same time the gold price has been correcting in this cycle. The price fell from $198 an ounce to $112. It briefly touched 102. That 46% decline prompted many news magazines and pundits to proclaim that gold is dead. Time magazine, appropriately named because their timing's impeccable, came out with an article in 1976 in this issue, which declared that gold was busted. The Great Gold Bust is the title of that article. And in August of 1976, it marked the exact bottom in the gold price correction. Gold went on to rally from $112 an ounce to $850 an ounce by January of 1980. And then it did enter a bear market. But those who sold during this correction period missed out on the most extraordinary run-up in that asset's price. And similar to 1975 and 76, we're enduring a promise of prosperity just around the corner. In 1975, Saigon fell, the US exited Vietnam. We're trying to get out of Afghanistan and Iraq. New York City was on the verge of bankruptcy and pulled away at the last minute. And of course, we had a president who was quite unpopular, and he had been driven from office. So at least if things weren't getting better, they weren't getting worse. And then there was this problem of inflation. Arthur Burns, then Fed chairman, told us that, don't worry, we've got it under control. The markets wanted to believe it. Again, our innate optimism wins out. We can't lay on the carpet forever. We've got to get up and fight again. And so in 1975, with the fall of Saigon, with Gerald Ford taking office, the stock market began to ascend. It started to rally. And in 1976, it moved higher. Gold had been a safe haven during those times of stagflation, an umbrella, if you will, during a rainy day. But when the sun came out, or at least was expected, who needed an umbrella? And so it goes. If we fast forward to today, in May, Time magazine published an article, and the article was entitled, "Is Gold About to Bust?" That in and of itself doesn't guarantee we've hit a bottom, but it's fascinating that even the wording and the title of that article are eerily familiar and almost the same as what was written 35 years ago. But it's worth visiting what's really happened in the gold market because it's fascinating to me when you try to put the pieces together. The gold price came under heavy selling pressure. The normal human volume on the COMEX Gold Futures Exchange is listed there on the left side of the screen. Traders that normally operate in the COMEX execute contracts that total about 250,000 contracts a month. It's in the thousands. About only 1% of those contracts actually settle for physical delivery of the metal, which are producers. So about 2,000 contracts a month, people demand physical delivery. So if you're a gold mining company, you want to guarantee the price, or maybe a bullion dealer, you'll take physical delivery if you think that the price is moving in your favor. That's only 1% of that market. The rest is speculation. If I buy a contract giving me the right to sell, in order to close it out, I buy another contract giving me the right to buy. Paper cancels paper. Something interesting happened, though, later in that month. The contracts ramped up into the hundreds of thousands. Now, I should give you a little backstory. Many of you might know that since the end of World War II, the gold of the European central banks has been held in the bedrock of Manhattan under the Federal Reserve Bank. It was believed to be safer there. France didn't trust Germany, Germany didn't trust France. Who was going to confiscate the gold? Let's get it out of Europe and just keep it, put it into America for safekeeping. In December, Germany demanded their gold back. Aha, very interesting. But Germany was forced to accept a 7-year delivery of gold. So rather than getting all their gold back at once, they're going to take it over 7 years. Interesting. Then in March, ABN AMRO, the Dutch bank, which is a European bullion bank, the counterpart here in the US is JP Morgan Chase, one of our bullion banks. They store gold for clients. They sent out a letter to all their clients saying that they would no longer give them physical delivery of gold, that they would only cash them out at the current price. They would send them cash. And then the letter went on to say, don't worry, we do have your gold. We're just not going to send it to you. Right? Have we heard that before? Remember when Bear Stearns collapsed? And they said, the 2 funds you've invested in have effectively no value, but don't worry. We love you and we appreciate your business and we're still fine. And then 6 months later, there was no Bear Stearns. They were fine for 6 months. So this is very interesting. And then in April, Citigroup and UBS, the brokerage arm, said that the best idea they had this year was to short gold. We should sell gold. Not to be outdone, Morgan Stanley joined in, and then the vampire squid, as we affectionately call them, Goldman Sachs, said that the best idea they had of 2013 was to short gold. Those all set the stage for this huge ramp up in orders. And then came, and by the way, the Goldman Sachs short recommendation was April 10th. On April 12th, the number of sell contracts, put options on the COMEX spiked to a record high. First it was 200 tons, then 400 tons, and then when the market opened again on Monday, April 15th, 200, 400, 600 tons of gold were to be sold. Now, the total amount of gold selling was equal to over 115% of annual gold production in the span of those 2 days. It's impossible to deliver that gold. Now, when I think about this, maybe it's just a coincidence. But I wonder, what's the objective? Sometimes it's just traders, you know. Before, when we look back at just October of last year, Citigroup had a target on gold of $2,250. A mere 4 months later, they're saying to short it and the price should be $1,200. The same with UBS. Not to be outdone by Citi, their target was $2,600 an ounce. At the time, gold was trading at about $1,700. Maybe, again, they saw an opportunity because of gold's weakness to profit from short-term moves, and they sold it off. So maybe it's over. Maybe this was just traders making a short-term profit. But maybe, just maybe, there's another objective. Maybe in this world of paper receipts and expanding financial obligations that are pyramiding above the assets that actually support them, it's hard to find where the real gold is. And maybe, just maybe, the banks were saving themselves. Because there's a shortage of gold, the easiest way to get it is to shake it loose from fearful investors. And the gold ETFs, the exchange-traded funds which hold gold, have had record outflows. 400 tons, 600 tons, as investors like us who use those vehicles for convenience to purchase gold and hold it have been forced sellers. Now, again, this is speculation, but if ABN AMRO, the bullion bank, doesn't have gold, and by the way, JP Morgan Chase's eligible gold for delivery fell from 2.5 million ounces to under 400,000 ounces in the 2 days following this crash, you have to wonder, it's possible that the banks were saving themselves, pushing the price down so they could buy it back and have that gold for delivery. Time will tell, though. We should see then the price move up as physical demand increases. And boy, has it. This chart shows what happened after the price of gold collapsed. I've used here the demand for gold eagle coins as just one proxy. But don't take my word for it. Look around the world. In response to the gold price falling, people lined up 30 deep in Tokyo and Hong Kong. They lined up in the shops of Mumbai to buy jewelry and gold. China's central bank increased their imports by over 500%, and the demand for Gold Eagle coins spiked by 500%, so much so that they actually ran out of stock. On the newswire, just yesterday, there was a quote from the head of the U.S. Mint saying that demand remains elevated and still near all-time highs for coins. So when we look at this market, we also think, well, what else could go wrong? And you know, in investing, it's a truism. First come the innovators, then come the imitators, and then come the swarming incompetents. And here comes the swarm of incompetents. Whenever the amount of short contracts on the gold market has exceeded these levels or been this high, it's meant that there's a rapid turnaround in the gold price. Each time, as you can see, when the shorting of gold was at its peak, what quickly ensued was a rally in the gold price, most recently in 2011. There's a mechanical reason for that, because if I am selling gold in the market, I've actually borrowed it from someone. And if the price starts to move up, I have to buy it back to give it, to return it from whence I borrowed it. It creates a negative feedback loop where actually a small rise in the price begets more buying by the short selling crowd. So to be very direct, we're more bullish on gold than we've been in a very long time. But we recognize that the structures we've used, the gold ETF, may not be the best and most secure. And we've been working to change that so that we can promise each and every one of our clients and ourselves that we know when we invest in gold, the gold is there. Not a basket of certificates, not paper. The world is overproducing paper, and we don't want it. We certainly want the real thing, just as the rest of the world has. In fact, it's interesting too that gold mining stocks have been hit harder than the price of gold. And for the first time since 2009, we think that those actually offer, in some ways, more value than buying physical gold. So gold is one thing. What else can we invest in to protect ourselves in this era of fiscal bank and government profligacy? What is the most hated asset in the world? It's long-term treasuries. You know, we're contrarians, as I mentioned. And one of the things I learned, especially when we started accumulating treasury bonds in 2009 and 10, more purposefully, I was really shocked. And I'm embarrassed to say, a slow learner in this case, as to why everyone hated bonds. Everyone. I don't have to tell you. You can open the paper. There's a warning. Bondholders are going to be eviscerated by higher interest rates. Get out now, before it's too late. Sometimes, of course, this is a sales pitch. Wall Street hates bonds. The brokerage firms hate them. Why do you suppose that is? This moribund state asset, this is your grandfather's investment. It doesn't move, it doesn't turn over, it doesn't generate any commissions. You need to buy the hot stock. You need to get out of these bonds. We need to get some of that VIG, get some skim, some commission, turn over those accounts. So generally, the big bulge bracket banks and investment houses do not promote investment in bonds. And also it's viewed as antithetical. If you own bonds, you must be bearish on the stock market. And that's sort of a communication disconnect for many of the big banks, which again want to drive investment into the stock market and generate more commissions. But what about economists? Economists hate bonds too. I think this is also part of the recency bias. We've lived through 70 years of expanding inflation. It's very hard for us to envision a period where interest rates are consistently dropping, or where prices are dropping, where the deflationary undertow is real. We always think an increase in interest rates is right around the corner. And of course, as interest rates increase, as we've experienced recently when rates have backed up, bond prices do fall. So get out now. Sometimes it's in the form of a sales pitch from your mortgage lender. Hurry and lock in low rates before they go up. You've got to run down and sign a new mortgage application. Again, a sales pitch. But one of the most amazing things I learned was that even bond fund managers hate bonds. Now, this one took me the longest to figure out, but bond fund managers are notoriously conservative, and they do very simple bond math. But I had to wonder, bonds have been in a 31-year bull market, and the returns on treasuries, long-term treasuries, actually exceed the returns on the S&P 500 over that period, better than the stock market, though no one's recommended them. Same with gold. Why do bond fund managers who've benefited so much, who've been enriched by the progress in bonds, by their returns, hate them so much? Well, because when those bonds mature, they have to sell them and reinvest the proceeds in a bond which yields less. It's called a reinvestment risk, and bond fund managers hate it. They like to keep those old bonds that pay 9 or 10%. So would we. But they eventually mature, and now you've got to buy bonds that pay you 3%. But if we look, the real question becomes, we own these treasuries both as a safe haven and because we believe we'll generate capital gains here as well as safety and stability over the longer term. How low can interest rates go? Let's cut to the chase. When will we make money on this trade? On this positioning, this investment? People say interest rates are at all-time lows. That's really not true. This chart can make that clear. These are the real returns, the real yield on long-term bonds. And you can see there are many periods in history, especially adjusted for inflation, where yields have been far lower. A little bit of bond math for all of you to tell you exactly what this means. We believe it's entirely possible, of course, and even more probable, and we have more confidence in this than we have in the last 10 months, that interest rates will fall, and we'll see a print on the bond that's closer to 2.5% soon than we are at the 3.25%. If interest rates fall on the 30-year Treasury from 3.25% to 2.5%, where they were roughly last summer, that would be a 24-25% gain in the bonds, plus whatever interest they pay us. If interest rates fell to 2.25%, it would be closer to 35%. If we get down to 2%, it would be about a 47% gain in the bond price. How realistic is it that we'll get to 2%? We got to 1.55% in 1900, 1.55% in 1921, 1.69% in 1941, 2.06% in 1946. Oh, that's ancient history, Chris, I know. If we look at Switzerland today, Swiss 30-year bond yields are at 1.36%. Japan, which I just mentioned, is a poster child for fiscal irresponsibility, has a 30-year bond which will pay you a whopping 1.89%. It's not only possible, it's probable. Some say that inflation's just around the corner, and that's why we won't see bond yields fall, because inflation should push interest rates higher. But where is this inflation that we're promised? Commodity prices have been a good proxy for inflation. There's very little human labor value added because labor values can be squeezed, layoffs, etc. So finished goods prices aren't always the best measure, but commodities are. Raw materials, what do they cost coming out of the ground? It's a good measure for inflation, and commodity prices have not only rolled over, they're plunging. Interestingly, for fun, we plotted commodity prices against the S&P 500. Historically, they've been highly correlated. It makes sense. If the demand for commodities is improving, then so should the world's economies be expanding, and the stock market's moving higher. But this divergence, which started last October, has not been corrected. This is one of the interesting divergences we're seeing. Now, the stock market has recently experienced a little trouble, but it continued to move higher even as commodity prices sank. Another measure of inflation that's more direct are 5-year Treasury inflation-protected bond yields. To get the break-even rate, you subtract normal 5-year Treasuries or similar maturity from their Treasury inflation-protected peers. It's meant to tell you what is the market's expectation of inflation. The expectations for inflation are falling dramatically, and this too was a relationship that was highly and positively correlated to the stock market. but it's yet another divergence. And of course, there's the elephant in the room. If there's no inflation that's going to push yields higher, what in the world's going on and why are yields moving up? A lot of it, of course, has to do with Fed policy. You hear often that if the Fed were to taper or stop QE, right. It's all talk, folks. But even if they were to, what would that do to bond yields? The Fed is, after all, buying bonds. Each time, as this chart shows, that quantitative easing ended or stopped or wound down, or as the antibiotics wore off, Treasury yields not only fell, they plunged. I can't tell you how quickly I want the Fed to stop, for moral, ethical, and, of course, investment reasons. I don't worry about a tapering, I encourage it. I don't worry about the loss of QE, I encourage it. Rates will find their level. And I actually believe that the Fed is not intent on keeping rates down. As you can see, the stimulus each time it's implemented pushes interest rates up. And as we all have felt, they push our bond prices down. Interestingly, the magic again is wearing off. And since February, bond yields had fallen. In May, there were some challenges, and we'll talk about that too. But we think that'll be short-lived as well. So the barbell, the positions that we've held, are expressions of how we felt really since 2008. Finally picking the exact point at which this 70-year credit and debt supercycle ends, and when the defaults start to happen and cascade like a waterfall is impossible to pick with any accuracy. But as Robert Frost said, the only way out is through. And just like in the 1930s, everyone must recognize that we are not going to be able to pay off all of this debt. In fact, it's not only Japan that has 50% of their debt maturing by 2015 that needs to be rolled over. It's most of the developed world. It's about 54% of the developed world has debts that are maturing by 2015, just a year and a half away. And the bond market should sniff that out sooner rather than later. So these still represent strong ideas and expressions of our belief and ways that we can protect our clients from some of the challenges, the overproduction of paper, and claims that we see will wash away through default, inflation, or both. But what have we been missing? The stock markets of the world have moved higher. This chart shows that. The main line, the large blue body, is the Dow Jones Industrial Average. But also on this chart is the DAX, the German stock market index, the French CAC, the IBEX, the Spanish index. All of these stock markets have moved higher. What is this telling us? Maybe Francois Hollande is right. Maybe the crisis is over, and the stock markets of the world are sniffing out some future growth. Something is happening that we are not seeing, and they're anticipating growth in the future. But again, there's a divergence. There's something rotten in Denmark, because the emerging markets like China, the Shanghai Composite, other emerging markets like Vietnam, rolled over last fall, November and December again, and headed lower. And these markets have always, for the last 20 years anyway, consistently led the developed world higher. Brazil, Russia, India, China, the BRICS as they're called, joined by now Vietnam and some others, South Korea. They are the engines of global growth, just like small businesses in America are the engines of our growth. Those small up-and-comers push growth higher. Why have they rolled over while the developed world's markets have gone higher? Well, it's not, we think, because of the economy. This chart, in a general way, just shows the purchasing managers' indexes from the same countries. PMI, a purchasing managers' index, is a survey taken of manufacturers for all countries that are in the World Trade Organization. They ask the managers, what are your inventory levels like? What are your sales like? What are you buying? Who are you selling to? These surveys are meant to give us an indication of the state of global manufacturing for every country in the world as measured. The purchasing managers' indexes have rolled over. It really looks like global production peaked in December of 2011 for this cycle. There is no growth anywhere to be found. I'm looking, there's no growth. In the US, we're not in a recession, but this chart, courtesy of Jim Bianco and Bianco Research, shows what's happened to our GDP. The red lines are considered to be subpar growth. Most economists think we need growth of 2.5% or greater to add jobs to the economy and to continue our expansion. These red bars then are suboptimal. It's as if the economy came home with a report card that showed a big C-. We're lining up a lot of those bad report cards. But if you open the newspaper, recovery's just around the corner. We're all going to Harvard, y'all. Not with these grades, we aren't. And you can see also the trend going back from the early 1980s all the way to now is one of an ever declining GDP growth rate. Just like with debt and GDP growth, we're coming close to hitting the zero bound. The growth rates are getting smaller and smaller. Again, this isn't recessionary, but it's certainly lackluster. If it's not the economy or economic growth driving stock prices, maybe it's earnings. Operating earnings on the S&P 500 have been also in decline. And many of you will say, Chris, of course, I'm an astute observer and investor. It's not earnings per se, but earnings per share that matter. And it's true, companies have been buying back shares to shrink their outstanding earnings, make the earnings per share increase. There's been some financial engineering, and that can drive stock prices in the short term. But the result of this declining earnings picture should surprise no one when it comes home to roost. Even more worrisome is the decline in revenue. Around the world, sales are slowing. So it's going to be harder to squeeze earnings per share out of a declining sales trend. You can't fake this number, folks. No accounting will change it. When sales are down, they're down. And revenue expectations also are in a declining trend. Maybe the stock market was undervalued, and so this rally is just a catch-up. We're catching up from our undervalued place to a higher valuation. This longer-term chart shows one measure of valuation, the Shiller adjusted PE, price to earnings multiple that's smoothed over 10 years. Robert Shiller's a Yale professor, and he took the idea that Benjamin Graham, the value investor extraordinaire, had of looking at a company's earnings over a longer period, 10 years, to smooth out the business cycle and cyclical adjustments and changes in management, and measuring that smoothed earnings picture against the price of stocks, we see that we hit some extraordinarily high valuations in the early 2000s. Extraordinary. Over 45 times earnings. We dwarfed what happened in 1929 back in the year 2000 with the tech stock bubble. And you can see that on an inflation-adjusted basis, we're in this declining trend. I'd also like you to notice that at least previously to this period, no cycle has ended until it's fully reverted beyond and below the mean. And durable bull markets have always begun from a price to earnings multiple that was in the single digits, 7, sometimes the low double digits, 10 or 11 times earnings. So the bull market, which began in 1921, started from a place of about 6 times earnings. The recurrent market that started in 1932 from that bottom, 33, also from about 7 times earnings. 1946, 10 times earnings. 1982, 7 times earnings. Today, the market is valued at about 23.8, almost 24 times earnings on a normalized basis. That's 31% higher than the long-run average of 16.5. Now, overvaluation alone isn't a reason to say that the stock market is going to crash or fall. That's not my prediction. And you all know my crystal ball cracked a long time ago. But I will say that this declining trend is real. But maybe this time is different, and we can start a new bull market from these elevated levels. But as you all know, I'm skeptical. One other thing that has our ears perked up is that margin debt is at an all-time high level. This is adjusted for inflation, but in nominal terms, margin debt, meaning people who've borrowed money to buy stocks, is at an all-time high. And this, just like the shorting on the GOMEX gold market, is usually an indication of a peak or a near peak activity. When there's that much borrowed money in the stock market, it's a very speculative endeavor. And again, we can speculate. We could follow the herd, chase stocks higher. We've so far resisted that. And this, again, is another reason for caution. So this is what it looks like. The U.S. macro, another interesting divergence. These divergences are everywhere. U.S. macro is a blend of the Citigroup and Bloomberg surprise indices. They look at about 30 different leading economic indicators at Citigroup. Bloomberg uses dozens more, but they track each other very closely to tell us what's happening with the economy or what can we expect. Expectations for the economy are tanking, but don't tell the stock market. It's still moving up. Earnings expectations, as we've seen, are kind of a game system, but earnings expectations keep being guided lower. And when I say it's a game system, one of the things you'll hear is, 68% of companies are beating their earnings estimates. Well, who manages the earnings estimates? The companies themselves. It's self-referential. It's the most ridiculous thing, but it gets repeated over and over. It's not the only ridiculous thing we have to put up with daily, but a company tells you we're going to earn 19 cents. Then they tell you we're going to earn 16 instead of 19, and then they earn 17, and it's a beat. It's a game system. But it is what we deal with every day, and yet companies are guiding earnings expectations lower, and revenues are falling, but the stock market keeps moving up. Personal spending is down, and I don't know if you've seen this, but in the first quarter, the BLS just reported last week that hourly wages fell by the most ever. A 3.8% drop in the average hourly wage. That's the most ever. Wages for working people, labor's share of income, is down 8.8% since the year 2000. Consumption is therefore down, and personal spending is down. And unemployment is up. Everywhere you look in the world, except for Germany right now, unemployment is up. German unemployment, the pink line at the bottom, is actually lower than it was when the euro was introduced. The rest of the countries in the Eurozone aren't so fortunate. Youth unemployment, of course, which is the powder keg that many economists, sociologists worry about, has spiked higher. In Spain, in Greece, it's over 60%. Of course, it's been the response to every crisis that we've seen. The market is moving higher on the expectations that central banks around the world will continue to reflate. Again, the strong innate optimism and a recency bias, the markets have, after all, gone up, create this momentum chasing and this herd-like idea that the markets will be okay. Do you all remember 2007 and 2008? Were we told to have confidence then that the markets would be okay? Not to worry about housing? Ben Bernanke said the Fed is currently not forecasting a recession. In August of 2008, we were already in a recession. So much for the seers. We were also told that subprime would be contained and that the Fed would come to the rescue. And the market fell 54%. We were told in 2000 that Alan Greenspan had our back, that the Greenspan put would save the day. The market fell 56%. This increasingly speculative activity is being driven by the belief that there will always and everywhere be someone there to save the day. And I understand it, I mean, you could see from those charts that our manufacturing activity globally has slowed down. But there's one thing we keep producing more of: paper. It's a pyramid, inverted, where we're producing more and more financial assets and producing less and less real stuff. How long can it go on? I don't know the answer, but it is worth contemplating. You know, the central banks of the world are telling us that we have to have confidence. And they forget that the real question is, why is it that just now we should have confidence? Or what is the real reason that this confidence may be lost? Those are the real questions. Japan, of course, has a massive debt we've talked about, and they've embarked upon an aggressive advertising campaign to instill confidence in the masses. This is one ad. They have some with sumo wrestlers, famous pop groups, appearing in magazines and newspaper ads and on the subways all around the country. I found this one to be extremely fascinating. All these young ladies are saying or telling the world what they like in a man. And the one on the upper left says she likes a man who is financially stable. In the middle, she says, I like a man who has investment savvy and does not take big risks. And of course, to finish it off, an investment in Japanese government bonds would make that man most attractive to me. How better to show that you're stable, not speculative, than buy those government bonds? And you just might get lucky. I took this from the Ministry of Finance website, and I ran it through a Google translator, so you'll forgive me. But Japan is really at a crossroads. They really are. They have had current account surpluses, meaning that their balance of trade was positive. The government had this net surplus of money that they could use themselves to keep buying Japanese government bonds, suppressing the volatility, keeping the interest rates low. Starting last October, Japan swung into a deficit. Part of that is problems with trade in China. About 10% of their exports were going to China, and the fight over the Senkaku Islands has meant that China's resisting and refusing to take imports from Japan. But really, it's a demographic balance. For the last 6 years in a row, the death rate in Japan has exceeded the birth rate. 6 years in a row. It's an aging population, and they don't have the replacement birth rate to make up the difference. And people who are graying and retired are not net savers anymore. They're dissaving. They're spending their savings so they can live, so they can enjoy life, go to the casino, get a hip replacement, do whatever you need to do to eat. And Japanese households own, in the main, Japanese government bonds. So now there's been a net selling of Japanese government bonds by pension funds, and this reallocation is happening. Bond yields in Japan are spiking. The level of debt to GDP in Japan is about 240%. So the math is a 1% increase in interest rates in Japan means 2.4% of their GDP has to go now to interest charges on money that was already spent. Spain is complaining and saying that they're facing a default because now 35% of their GDP has to go to debt payments. Spain is saying they're at a crossroads because now they spend more money on debt service than they do to pay the ministers who run the government. Japan's very close to. A 1% increase in rates would cost them 2.4% of GDP, and their GDP last year was 0.6%. There's no there. But what's the response? If Japan has financial collapse, how do government bonds will? How will government bonds do? Is really the translation. And it says government bonds will be redeemed because the government is responsible. Please do not worry. So we really feel that we're at a crossroads, and that the resolution of this will be positive, even more so for the investments we hold. And we think that this is happening now as we speak. In the last month, Japanese government bonds spiked. The prices collapsed, the yield spiked, and they had to halt trading 3 successive days because of that volatility. This is just the beginning. Kuroda, the Japanese central bank governor, and Abe, the prime minister, have vowed to print more money and drag that country out of its deflationary spiral. They're printing much more money than we are, and I think that that's creating some contagion. Many of you saw in May that some of the bonds backed up to February levels again. I sort of think of that as a double bottom. I don't want to get too technical and we can talk about it, but in reality, there's been a tremendous sale of government bonds in Japan. 90% of those bonds are held by households who are aging, and the pension funds and the insurance companies in Japan. It means that if Japanese government bonds are no longer high-quality collateral, what's left? European bonds? No, U.S. Treasuries. And the money coming into U.S. Treasuries as a result of the problems in Japan, I want to be clear, it's not an endorsement of our government or the way we do things here. There's been a red tide of money created by central banks around the world. And in the self-interest of those moneyed holders, they're looking for the safest place to park it. And the safest place, we think, the tallest midget, will still be U.S. Treasuries. This quote is from a gentleman named Otto Friedrich. It's a great book, Before the Deluge. The fundamental quality of the disaster was a complete loss of faith in the functioning of society. Money is important, not just as a medium of exchange, after all, but as a standard by which society judges our work, and thus ourselves. If all money becomes worthless, then so does all government, and all society, and all standards. In the madness of 1923, the Reichsbank inflation, a workman's work was worthless, a widow's savings were worthless, everything was worthless. Again, I understand fully that this discussion can be difficult, and sometimes it's hard for us to get our arms around it. But I want to be clear. We aren't talking about Armageddon. That's the end of the world. We're talking about a financial change and a restructuring that has to happen, and we've been through this before. Brazil recently is 1993, Argentina in 2000, and again, soon, repeatedly. In 1938, by 1938, 48% of the governments of the world had restructured their debt. It wasn't the end of the world, but it was a financial change, and we should be prepared for it. And by the way, if you step back and look at the world, you can see that it's happening. I mean, we are told over here that the crisis is over. Europe's going to be fine. Yesterday, Germany reported their export numbers down 10%. Their ISM, their manufacturing index, fell into negative territory. And this follows on a print where France has triple dipped into a recession. Really, when do we call it a depression? I guess that word is no longer politically correct. But this is the world we're in, and inevitably, these debts have to be restructured. The response has been to make more paper, but there are ways we can protect ourselves. I've shown you two, and there are others too, that we're, again, implementing in the client portfolios to protect us in this challenging time. This is what we see happening. Thank you all very much for being here. Thanks for your time on a Saturday morning. I appreciate it. Thank you. Thanks.